Good morning, everyone. Did you know that the month of May is Financial Awareness and Literacy Month? As part of our dedication to helping Latino small businesses with resources and training, the LA Latino Chamber is delighted to present this exclusive webinar designed and presented by our partners at Bank of America. Today's topic is getting your business loan ready. This includes getting you equipped with tools to secure the perfect loan, discover inside tips on optimizing your loan application, understanding the required loan documents, and most importantly, gain invaluable insight into navigating the Access to Capital directory, an important tool at Bank of America. I'm Olivia Rios, Director of Operations and Programs at the LA Latino Chamber, and we welcome you today. Today's topic is very important for all small businesses because we are not always clear on how to grow your business, especially how to qualify for loans. We'll share the various factors that impact on getting a loan, what to look out for in your business and personal finance, how to not be a red flag, and how to improve your odds of getting that loan. At this point, I'd like to introduce you to Valerie Rivas, Vice President, Small Business Community Officer, and Carlos Gonzalez, Vice President, Small Business Banker, both at Bank of America. Good morning, Valerie and Carlos. We're excited to have you here with us today.
Olivia mentioned my name is Carlos Gonzalez. I'm a small business banker with Bank of America with over 15 years of banking experience. And what I do as a small business banker, I help many small business owners like yourselves, not only with obtaining a loan, but also with their day-to-day banking. So it's a pleasure to be here, and hopefully we can make this interactive. So feel free to ask questions. So I'm excited to present to everybody.
Hi, good morning, everybody, and thank you so much, the LA Latino Chamber of Commerce, for having me here today and for your continued partnership. Again, my name is Valerie Rivas. I am Vice President for Business Community here in the LA County area. A little bit about myself. I have been in the industry for 20 years, been serving entrepreneurs and businesses like yourself for the last 14 years. I think I already said I've been in the industry for 20, but been with Bank of America for the last 10 years. I do stand in 5 different nonprofit boards, 3 of those being executive. I want to highlight I'm part of the board for Bank of America for Better Money Habits, which is part of the financial literacy piece and making sure that our volunteers are out there and they're trained to be able to provide the financial literacy in our communities. In addition to that, I'm part of the Hispanic Business Council, and I also help out with the Hispanic Business Council to be able to do local initiatives for the need of our Hispanic community business owners. As far as my role, mine's a little bit different than Carlos. I partner up with nonprofits and organizations and support their constituents, and I provide financial literacy, tools, resources, and most importantly, access to capital beyond to what we have to offer here at Bank of America. All right, so today we're going to be talking about how to get you loan ready and pretty much different financing options. So I did want to bring up our 2024 Small Business Owner Report that we did just recently. It just came out last week. Now, last year in 2023, when we did a small business report, we actually were at 82% of our clients that needed some sort of access to capital. And I should probably tell you what it is that our small business report, why it is we do it. So we do it so that we can serve our clients better, understand what their needs are, and how as a bank we can support the business owner. Now, again, going back in 2023, 82% of our clients were actually looking for access to capital options. And this year, it actually went down for 2024, it actually went down to 71%. Now, what I did find interesting is even though the need for access to capital went down, our clients actually started to carry their balance on their credit cards. So now they're carrying the balance 20% more. 20% of our clients are now carrying the balance more. So what that tells me is there's still a need, either that or maybe they could just be in the wrong product. So because of that, today is very important, and we're going to go through not only how to get you loan ready, but also what type of documentation is needed, but more importantly, so that you are not carrying your balance on your credit card, what type of financing is available out there so that so we make sure that you're in the right product. As you know, credit cards, it could be high interest rate, especially if you are carrying the balance for the wrong items. Today we'll go over different financing options that are available. So what's in the agenda today? We're going to talk about accessing capital, the 6 C's of credit, which you'll probably see throughout a lot of our presentations, and the most common financing options available, specialized financing, and alternative financing. Now, whether you're an established business or you're a startup, there may be a time that you need some sort of funds to help with the growth of your company or support anything that your company might need, such as hire employees, maybe expand, maybe you want to start a new venture. So because of this, banks, we want to go over today what banks look for. So we are going to start by going through the 6 C's of credit, and I'm going to go ahead and let my colleague Carlos go ahead and go over it.
Yeah, thank you so much for that information, Valerie. So as Valerie mentioned, we're going to talk a lot about the 6 C's of credit. This is, different. This is a very common requirement that you're going to see not only with Bank of America, but with a lot of the major banks out there, especially the banks that are cash flow lenders. So what does it mean when a bank tells you that they're a cash flow lender? That takes us right to the first C, which is capacity. So in order to get a loan with a cash flow lender with one of the major banks, you need to make sure that you have the capacity to repay back that loan. So what does that mean? It means that you need to, on your tax returns and financial statements, show that you have the ability to pay us back, and also have a buffer there. So typically, we want a business to generate at least $1.25 of excess cash flow after operating expenses to make sure that you can support $1 of debt. So again, for every dollar of debt that you have, you should have $1.25 of excess cash flow. So that's the first C, capacity. The second C, which is capital, sometimes it may also be referred to as liquidity, is how much capital and what type has the ownership invested into the business, and does the business retain an adequate portion of the capital within the business? So what this means is, in essence, is your business running on fumes? Are you day to day, or do you have some savings there in case there's some sort of disruption to your business, that you're able to sustain operations with either savings that you have in the business or maybe even personal savings? The third C is collateral. And so on the collateral piece, whenever you ask a loan for a bank, ideally the bank wants to have collateral. So if you get a loan to buy commercial real estate, then your collateral is going to be the real estate itself. If you go in and you ask for a business line of credit, then in that sense, a lot of times the collateral is going to be the inventory or even things like your accounts receivable. So that's the different type of collateral that we see in for business loans. The fourth C is conditions. And so that has to do with overall market conditions. So know your business, know your industry. This is something that you want to address with your banker ahead of time. If there's anything in your business that could be a potential disruption, it's something that we want to address ahead of time. An example of this would be, let's say last year, a lot of the entertainment industry was shut down because of the writer strike and the actor strike. So if your business supports that industry, we want to make sure that you let us know how your business is going to operate throughout those market conditions. The fifth C is character. And this is where lenders may evaluate business-related attributes like a business owner's experience, knowledge, financial competence, personal credit history, and future business plans. So this is very important to, again, address with your banker ahead of time. We're going to look at things like your personal credit to help us determine your likelihood of repaying back a business loan, since it may be similar to how you've been paying personal credit. You also want to talk about your experience. Your business may be fairly new, maybe you're 2-3 years in business, but prior to that, maybe you had a key responsibility within another business, or maybe you spun off and you used to have a business partner, now you're doing it on your own. So things like that, we want to know. We want to know what experience you have prior to applying for the loan. And the last piece is communication. So you want to make sure you establish an open line of communication with your banker. And I would recommend that you communicate, even if you're not applying for a business loan, communicate with your business banker regularly. Have a conversation with them every 6 months. You never know what you may be missing out on. And it's never too early to start communicating with them. If you think you may be interested in purchasing your building maybe 3 years from now when your lease is due, have that conversation early on. Let your business banker know about it. Have them take a look at your tax returns. That way they can start making recommendations. Because the last thing you want to do is have your lease up in 6 months, give your banker your financial statements, and you're going to have to go back and make adjustments because that could take a lot of time. So you want to be as proactive as possible. So make sure you always have that open line of communication with your banker. All right. The other important question is how the funds will be used. And this is important to know because we want to make sure that we set you up with the right loan. Valerie earlier mentioned that we see that there's been an increase in credit card balances throughout with our small business owners report. So make sure that you talk to your banker to make sure so that we set you up with the right product. If it's a short-term working capital need that you have, then we may want to do something like a business credit card or a line of credit. But if it's something that's going to take you longer to repay, such as a commercial real estate or equipment financing, then that may be a better fit for that may be a term loan. Also, the amount that you're looking to borrow. So that's something that I would say it's okay if you don't know exactly what your borrowing potential is. That's something that you want to work with your banker with, but also make sure you follow the recommendations. If you're a business with $500,000 in revenue and you're asking for a $2 million expansion loan, that may not be likely. So make sure you work with your banker to ask for a reasonable amount. So that's something that you want to also address with your banker. A little bit of what an ideal credit profile is like. So we talked a lot about when one of the 6 C's is character, and that's when your credit report comes in. So what do we want to see on your credit report? We want to see that you have at least 5 active trade accounts. So what a trade account is, it could be anything from a mortgage to a car loan to a business credit card. We want to see that combined with your business and your personal profile, you have at least 5 active trade lines. Ideally, we want 3 business credit cards and 2 loans that have been paid in full in the past. So that's a general 5-3-2 rule. And that's what we look for on the credit report. So factors that impact and your ability to repay back. So your capacity to repay, your application should demonstrate that you have the ability to pay back the borrowed money. So that's when we're going to look at your financial statements, your tax returns, to make sure that you meet that capacity requirement, that you're showing us that you have the ability to repay back your existing business and personal loans and take on whatever additional financing you're asking for. Some supporting items that you may need to support this is going to be your personal and business tax returns. We may also ask you to fill out a personal financial statement so that we can see your personal assets. And we're also going to ask for a balance sheet for the business so we can see the assets and liabilities that the business has there, as well as any cash reserves that you have. Lastly, what are factors that can improve your odds? So again, work closely with your advisor. I would say it's never too early to get started, even if you think you may be a year or 2 out from moving forward with getting the loan. You want to work with your advisor early on to make sure that your advisor and your accountant are working together so that they can prepare you for the loan. And you make sure you gather your information as well. This can include your tax returns, financial statements, putting together your personal financial statement, and your income statement and balance sheet for the company. So let's do a quick recap of what we've talked about. So remember, keep in mind the 6 C's of credit, and those are capacity, capacity, capital, collateral conditions, character, and communication. Let us know how you're going to use the funds, the amount that you're looking for. Your business and personal credit profile are important, and your capacity to repay back. So those are the 6 C's and different factors that the bank looks at when you're applying for a loan. And I'll send it back to Valerie so she can go over the different types of loan options that are available to you.
We talked about earlier how there's 20% more of balances being carried on the business credit cards, where before we were treating more as to everybody pretty much paying off their credit card debt on a monthly basis so that they don't pay interest. Now, because of that, it's very important today that you understand when it is that you may need to use a credit card, line of credit, or a term loan. So right now we're going to be going through the most common options for small businesses. Now, the first one is business credit card. And if you've already done our Building Business Credit workshop in the past, you'll know that this is actually very important to set you up for success. And when I say for success, it's for you to be set up to start establishing your business credit and keeping your business credit and your personal credit separately. Now, some of the benefits, it's easy to track expenses. You have fast access to cash, although I don't recommend it because the interest rate could be really high on that. Easy to manage employee spending. Cash and travel reward program is just a cherry on top. And also it helps you build credit history. So very, very important that when you are obtaining a business credit card, you are actually going with a credit card that's going to help you, not just hurt you. Why is it that I'm saying this? It's because there's certain credit cards out there that will go ahead and not report any of the good history, but the minute that you are 30 days late, they are the first ones to report you. So they're only hurting you, not helping you. So you want to make sure that 1, you talk to your banker, or 2, the lender, or 3, take a look at the disclosures to make sure that they are reporting to Dun & Bradstreet. Some other key considerations would be what type of interest rate you are getting, although I do recommend for you not to carry those balances, but just more use a business credit card to get pretty much free financing. So if you are to pay your statement cycle, the minute that you do get your statement, you actually don't have to pay us any interest. So it's a way for you, not only you manage your cash flow, but also a way for you to get paid, meaning that your clients are paying you back, but then also delaying your payable. So it buys you a little bit of time as a business owner to be able to pay your payables back. So people that you owe, or companies or lenders that you owe money to. It's not, as I mentioned before, this is not suited for long-term borrowing. There's other products that are available out there. So just make sure that if you're not sure what type of financing you should be seeking, sit down with your accountant or your business banker, more importantly, so that we can guide you and make sure that you go into to the appropriate product. The second one is business lines of credit. So business lines of credit are designed to help you manage your short-term financing, as my colleague Carlos mentioned that earlier, and also to help you improve and manage your cash flow. Some of the benefits to this, it could be where you can actually manage your seasonality. Now, what do I mean by that? Your fluctuations in cash flow. Now, for example, my father had an HVAC business. So during the summer, he was really, really busy because he fixed air conditioners. During the winter, people put on clothes and layers of clothes, so it's not as busy. But he did have a line of credit to help manage that cash flow when needed. Also, sometimes you might have slow pay clients, meaning that they're not paying you on time. Or you may also have government contract, which is actually really good to have also, but they may take a little bit longer to pay you back. Now, this could also be working capital when you need it. There's no cash advance fees, although some key considerations is that it may or may not have an origination fee or an annual fee. So make sure that you are aware so it's not a surprise when you are renewing it. And whether it's unsecured or secured, meaning that you're putting the money into the line of credit and doing your own line of credit, or if the bank is providing that line of credit for you. Other thing is that most of the time, business lines of credit, they are variable interest rates. So what does that mean? If interest rates goes up, your payment's going to go up. And depending on how much you owe on that balance, well, it could be a high payment difference. There's no fixed payment schedule because it fluctuates depending on your usage, and it is normal. So don't be alarmed when your bank will ask you for either financial statements, your tax returns at the end of the year, or a profit and loss and a balance sheet to see if you are managing the line of credit correctly. And what do I mean by that? That you're not over leveraging, that you're not overusing the line of credit. That could also be a red flag. Not only that, but you will end up paying a lot of interest if you're not paying that down consistently. Business term loans, this is for fixed assets, or if you're purchasing some sort of business asset, or you're financing some sort of business expansion for a long period of time, or for a period of time. Some of the benefits is usually the interest rates will usually be fixed, so make sure that you are aware depending on the lender that you go with. We have predictable payments. So typically if it is fixed, your payment typically doesn't change. So for example, if they tell you your payment's going to be $800 for the next 60 months, you know that on month number 60, you have no more debt if you follow the payment schedule. Payment amount doesn't usually vary based because the interest rates are usually fixed. And some other key considerations is whether the lender is giving you the loan or you're putting in your own funds to create the loan, which some businesses will do that to establish business credit. Financing options, small business administration loans or SBA loans. You probably heard this became a very, very popular during the pandemic with the disaster loans and the PPP loans, if you're familiar with that. Now, what are business loans? They're available through the business administration. And these are the way that I like to, one of my partners, my community partners, actually, when I explained it, he said it's kind of like you have a co-borrower standing behind you. So what do I mean by that? So the Small Business Administration helps you get into these loans with lower down payments, a little bit easier to qualify with credit, a little bit of a shortfall of cash flow. You have longer terms available so that you can help manage your cash flow. And pretty much when they say that you kind of have like a co-borrower standing behind you, is they guarantee a certain percentage to pay us in the event that the borrower does not pay us back. And so for that, these loans are built for the community to be able to get into loans. So although SBA may have a lot of different programs, sometimes your lender might put additional guidelines on top of that. Now, there is 3 core SBA programs, which is the SBA 7A, 504, and the Express. They're all slightly different and support different loans amounts. So 7A, you typically can use it for pretty much anything, and they're capped at $5 million. And this could provide financing for pretty much anything, like heavy machinery, a piece of real estate property, construction loans. And then we have the 504 loan, which is used for commercial real estate, large equipment. Also, the transactions are typically up to $5 million. And typically with this one, you only have to put 10% down. Typically with the 7A, it's usually 15% down. And then for SBA Express, those are for lower loan amounts. It's actually a little bit more of a streamlined product. It's a little bit faster. There's a little bit less fees associated, and those are capped at $500,000. You can also most recently use this for a smaller owner-occupied piece of real estate. So it's something that another product that was added for real estate, which is, $500,000. Unless you're refinancing in the state of California, it could be maybe very difficult to purchase something at $500,000.
Valerie, we have a question that came in the chat. Just kind of, if we can go back to the previous slide, a question came in from Vanessa, and it says, can you still get a loan if you have an outstanding loan that you're still paying that started in 2020 COVID times? So Vanessa, I'm assuming you're talking about the EIDL loan that Valerie briefly mentioned. If that's the type of loan you have, yes, you can still get a business loan. There's just, of course, 2 things. One, you have to have the capacity to pay back your EIDL loan and to pay the new loan that you're taking on. And then the other thing, when you took out that EIDL loan, the SBA, the Small Business Administration, they put an all business asset lien on your business. So that may prevent you from getting loans. However, the SBA can subordinate that lien. So there's some paperwork involved and you need to get approval from them. So as long as they're able and willing to subordinate your loan, then most banks can still provide you with financing. So just wanted to answer that question. And then we also have another question that came from Miguel Madrid. and he's asking how many years in tax returns do you need to have a loan? So typically, and again, this can vary from bank to bank, but with Bank of America for SBA financing, we ask for 3 years of tax returns, and for conventional loans, we ask for 2 years of tax returns. So Valerie, sorry to interrupt, but just wanted to plug in those questions since they related to what you were talking about when you mentioned the SBA loans and the loans that were done during COVID times.
No, absolutely. No, thank you for keeping track on that. I also did want to mention that if you are a startup, the documentations do vary. So we'll go through that a little bit more towards the end. But yes, typically it's 2 to 3 years. Thank you for jumping in, Carlos. Okay, so now we're going to talk about specialized financing. There's 3 different types that are typically used, which would be for commercial real estate, equipment loans, and practice loans. So for commercial real estate, SBA, you can actually get into a property with as little as 10% down. If you go directly with the bank, meaning that you don't have the SBA co-borrowing for you, then we would require at least 20% down. SBA also gives you longer terms. So for example, you come in and you say, Valerie, I want to do a commercial property, and you want to put the 20% down. The max, if we go conventional, we could only probably do up to 20 years. If you come in and you do an SBA loan with us, or pretty much with any lender, we can go up to 25 years. So as you can see, it gives you a little bit of a lower payment. You have a little bit of extra cash flow, and you can get into a commercial property with as little as 10% down. Equipment loans, very important that you let your banker know the type of equipment you are getting. And the reason I say that, because if you are getting, let's just say, some sort of Sprinter or some sort of work van, you might be able to finance that through our business auto loan. So check with your lender, and pretty much the application process is a little bit more streamlined and not have to ask for as much documentation. So very important that right from the beginning, you are able to provide that BIN number, see if it's something that we can put through our streamlined process, or if you have to provide more documentation depending on what type of equipment you are financing. Now, in addition to that, we can go up to 10 years going on as an SBA program. If we don't go SBA, the maximum we would be able to do is 7 years. Practice loans. So many lenders offer healthcare professionals to buy their medical, dental, or vet practice. The maximum loans can vary, and also it could be used for expansion, tentative improvements, or equipment purchase. So it is very, very common. And then also, it's funny because yesterday I did a podcast and they asked me, they said, Valerie, why is it your profession actually get up to 100% financing? And it all comes back to risk, right? So, and the market conditions, right? So we talked about the 60s earlier, we talked about conditions, and typically with healthcare professionals, they have an 80% success rate. As you know, with other industries, is not necessarily the same. So because their risk is so little, the banks can actually finance them up to 100% for those startup loans. They could also do acquisition loans and include working capital with that as well. All right, so now we're going to get into alternative financing. And this is actually one of my favorite areas, just because when we think about access to capital, we think about only what the banks have to offer, right? That's like our first stop typically. And for myself, my dad had offered me his HVAC business. My 2 older brothers didn't want it. And then I thought about it and I said, I'm a woman, but I guess I could own a business like this. I went to my parents' bank that they had at the time, and I sat down with their business banker, and he pretty much said, Valerie, since you don't have any experience really, or you haven't been involved in the business as much as the bank would like to, and also haven't owned the business for I think it was 1 year or 2 years back in the day, I forget. they pretty much turned me away, but didn't give me any resources, didn't tell me where I can go because I was technically a startup now taking over this particular loan. I'm sorry, not this particular business. So because of that, this is one of my favorites because this is information that I wish I had back in the day. Now, these are alternative ways that you can get financing, meaning that if your lender turns you away, or maybe you are not your credit might not be up to par, maybe you have shortfall in cash flow, maybe you don't have enough liquidity and enough money in your business account, you may want to consider one of these different options. And the first one is a community development financial institution. So these institutions, they don't hold deposits, but they are there really for the community development. And the nice thing about Bank of America and working here is that we're actually the #1 CDFI contributor. So we contribute to these nonprofits so that they can have these loans for the community. So we do have a $2 billion commitment. So very, very important that if you have some sort of business idea, or you have something, a new venture that you want to open up, or maybe your lender turns you away for whatever reason, there is still hope. You are able to get something through a CDFI. So make sure that you communicate with your banker, or find the resources that are available in your community to see where you can get that type of funding. There's also minority business development agencies, there's local regional funding, and there's also grants. And grants, this is actually something that you don't have to pay back. And talking about, actually did want to bring up that for our multi-owned businesses and women-owned businesses, Bank of America is currently offering a $25,000 grant for those that want to get into a owner-occupied commercial piece of real estate property. So it helps you towards that 10% down as long as you're going through an SBA program here with Bank of America. And also you may be wondering, well, where would I be able to find these different resources of, maybe I do want to start up my new venture, and maybe I got turned away from my current bank. You could actually access www.accesstocapitaldirectory.com. It's available to the community. You don't have to bank with us. It's just an additional resources that we created last year, because one of the things that our clients told us is sometimes we need access to capital and Bank of America is not able to help us. So we were able to create the Access to Capital directory that's available to the public, where you can go in there and see what type of lenders are available to give you funding. Now, let's recap a little bit about what we talked about today. We talked about short-term financing versus long-term financing. We talked about the most common financing options, especially so that you're not that client that is carrying the balance, but make sure that you're into the appropriate business products. So whether that's a credit card, line of credit, or a term loan. We went through the 3 different SBA core products that are available to you. And also we talked about the lower down payment that's available to you through those programs. And there's also specialty lending for equipment, commercial real estate, healthcare providers, but also make sure that you are communicating with your business banker to see what type of equipment you are purchasing, to see if you don't have to provide as much documentation. We also talked about alternative financing. And while in just a moment, I am going to show you a tool that we have available for you that just came out, and where if you're not able to get any type of lending, or maybe the guidelines, you're not just quite there for those traditional lenders, and where you can go and apply and find a lender that will help you get the funding that you need. Working with an advisor, very important. Carlos, I think, emphasized a little bit more on that. Very important that you are communicating with your business banker, but also your accountant, so that we can keep you on track and also prepare you for those big purchases or big goals that you have for your business. Now, before I get into the Access to Capital Finder, I am going to go ahead and just go through these QR codes. So you can go ahead and feel free to scan them. The first one is for small business resources. On there, you'll find our partnership with Cornell University, where we pay for women entrepreneurs to take a 6-week course to successfully run a business. You'll also find the Tory Burch Foundation, and where you can go learn more and potentially sign up for that program. That program has a mentorship, cohort, access to capital, very affordable options, and of course, a network that will help our women business owners thrive. You'll see our Seneca Women that supports retail businesses. You'll also see different resources like the 25,000 down payment grant that I mentioned earlier. A lot of different resources and partnerships that we've developed throughout the years to help better serve our clients and also the community. So marketing materials, filing your LLC or corporation, go on there. There's a lot of different resources, and please spread the word because we can only do we can't do enough of that. Better money habits. This is to improve your financial health. There's some self-help videos and also decks similar to the ones that you saw today. And the third one is for free learning. So if you have any other financial literacy topics for small business that you want, you can visit our education center and you can sign up for other workshops similar to what you watched today, cash flow management, how to start a business, different topics. So please go on there and sign up for our next webinar. Carlos, anything you want to add?
Just want to maybe emphasize on the working with your advisor part. Whether you're a client of Bank of America or another bank, most banks have a similar role to what I do, which technically my role is a small business banker, but really I like to see myself more as a relationship manager, where I like to work closely with my business owners, not only helping them with loans, but with other banking solutions. So it's important that you establish that relationship early on. If you don't know who your business banker is, next time you stop by your branch, ask, because most likely you do have a banker assigned to you, but a lot of times maybe you're not getting those calls. Maybe those calls are coming through as spam. You're not getting the calls, the emails. So I would just recommend everybody to establish that relationship early on with their banker.
So Carlos, someone on today's program is not currently banking with Bank of America. Can they contact you for assistance?
Yes, they can contact me. I think there's a question about someone that's located in the San Francisco area. Feel free to contact me directly. And if it's something that you need an in-person representative, I can always put you in contact with somebody in the area.
All right, perfect.
I wanted to introduce this new resource that we just created this year. It's called the Access to Capital Connector. So it's slightly different than the Access to Capital Directory. The Access to Capital Directory that I presented last time, you go in there and you can see the different companies that can provide you with the different loans amounts, grants, and different resources. With this one here, we actually get you in touch with a loan officer of one of our community CDFIs that we have partnerships with. So a little bit about the program. It's designed to help those business owners find capital in the event that you are not able to through your bank or your traditional lender. Coaching and support to pretty much run technical assistance to be able to run your business successfully. So it's very easy to use. It tells you the steps here. So the first step would be for you to review the frequently asked questions, which if you go on top, you can find the frequently asked questions right here.
Mm-hmm.
And once you do that, the next step would be to fill out a short pre-application, and we will be able to connect you with one of our community partners that we support. After that, step 3 would be connect with a partner and begin working with them with a loan application and a coaching program that you have chosen that fits that fits your needs, and you will be able to get the funding that you need. And there's different types of access to capital. As I mentioned, there's crowd funds, there's CDFIs, there is angel investors, venture capitals. So there's a lot of different ways that you can get the access to capital that you need. So if you have an idea, want to open a new business, or maybe you're just not quite there to get the lending with those traditional lenders, feel free to use this as additional resource to be able to get access to capital. Now, you may be wondering, how do I get there? accesstocapitalconnector.com, and it'll take you here. And again, it's available to everybody. I do encourage you to first go with your bank and see if you are able to. Of course, Bank of America is here to support you as well. But go there first, just because if you are able to get approved with those major lenders, you will get the best available terms, the best available interest rate that in the industry. So which is why today we wanted to go through the 60s of credit and how you can put that into play with your full financial picture so that you're ready for those bigger banks. And with that, this is all I have for you. I don't know, Olivia, if you want to add anything, Carlos, but I do appreciate your partnership for the LA Latino Chamber of Commerce. Thank you so much for having me and my colleague here today. And yes, I hope to see you next time.
Well, thank you. Thank you for sharing everything, Valerie. I know that I did have a question. So a reasonable amount, can you elaborate? I know you mentioned that you can support small businesses and possibly do funding for a new business.
The loan amount that you qualify for, it depends a lot on the type of loan that you're asking for. So for example, your business may be able to afford a $2 million commercial real estate loan, while they can only do a $200,000 equipment loan. The reason for that is that commercial real estate loan is going to be amortized over 25 years versus an equipment loan that's typically amortized over 5 years. So the loan amount that you qualify for can vary with the loan type and also the amortization. So some loans, again, are 5 years, some are 10. Commercial real estate typically goes up to 25, so it really depends. As far as startup financing, with Bank of America, we do have startup programs for medical professionals. So whether they're doctors, dentists, veterinarians, that's available for them. But for all other industries, we ask that you've been in business for at least 2 years. And if you don't meet those requirements, that's where the alternative finance solutions comes in, what Valerie mentioned, your CDFIs. So don't get discouraged. If you hear a no from a bank, try to convert that into maybe a not right now. Work with your banker and say, well, what can I do to prepare my business for financing? A lot of times it may involve working with the CDFI and then eventually coming back to a bank.
We have 2 more questions, let's see, or comments. That was, so if you're looking for Carlos's and Valerie's contact information, you can find them in the chat. And thank you both. The LA Latino Chamber is appreciative of the relationship and partnership we have with Bank of America. And on that note, we'd like to thank you for joining us this morning on this important topic, and we will hope you'll join us for the next session. Thank you.